You know, we repeat it often enough, but because it's worth repeating that even with the raging war in Israel right now, stocks are higher than they were at the start of the war, and the markets worldwide actually seem to be holding their own, albeit with the exception of those, particularly in Israel. But having said all of that, Scott Martin on the significance of this, Dave Maney on the significance of all of this. So, Dave, begin with you on stocks continuing the run-up we had last week at a less frantic pace. But what do you make of just the way the markets have performed through this war?
Well, Neil, I think that this war doesn't feel at the moment like a global conflict. I realize that it's a very serious situation and that we're involved deeply, but it isn't broken out into kind of open superpower conflict. So I think it is important to keep that in perspective. I would also say that there's a confluence of factors that are coming together. What has been an incredibly difficult and unusual time coming out of the COVID lockdowns and looking at what one of my longtime 30-year Wall Street veterans said this is capital formation environment that he's seen in his entire career. So, that's drawing to a close. And there are multiple things that, it's been crappy. And you can see multiple factors that start to kind of make a walkway out of which the market can begin to climb. And I think it has.
All right. Well, we're having some audio problems with you, Dave, but we'll try to work on that. Scott, in the meantime, one of the things that has come up is the resiliency of our bond market. It's well off of its highs. We've backed up a little bit on the 10-year, now closer to around the 4.6% level. But that's sort of done the Fed's job for a time being and eased concerns that this is going to get out of control. But where are you on this and this rate relief that we've been experiencing, again, from highs back in the late October of around 5%?
Yes, which wasn't pretty, Neil. Like you said, in the last week or so, we've lost about 50 basis points in there, so 0.5%. And I think you're right. That's doing the Fed's work, which probably preempts at least the Fed staying on the sidelines and eventually, my friend, cutting rates possibly next year. So the Fed is looking at the bond market now and saying, okay, rates are pulling back, so maybe we should too. And that's something that's supporting stocks here, especially tech stocks and healthcare and industrials, as they are over-leveraged, as they are at higher rates. And therefore, stock prices are going to go up if rates come down.
You know what's remarkable, Scott, too, when we look at this, is it's one thing for stocks to keep, kind of rolling along, but for Bitcoin to be back over, $35,000 a coin, for gold to still be in and out of $2,000 the ounce. You usually see one group or the other doing well, but right now they all are. What are you to make of that?
Well, the market is looking for alternatives. I mean, like you mentioned a few weeks back, when stocks were suffering, bonds were suffering, there wasn't much to do besides sit in cash or buy Bitcoin or maybe gold. So certainly, as Dave mentioned, as global tensions tend to rise, we tend to see, say, that fleet to safety, if you even want to say that can be attributed to Bitcoin, but certainly to gold. And that's something, too, Neil, as rates come down, the dollar will somewhat lose maybe some of its value that's had most of this year and therefore inflate commodities and things like gold and Bitcoin and some of the other alternatives that are out there.
Today's the day, Dave, we're going to hear from the President of the United States outlining his big rail initiative. I think it's going to be a little bit north of $16 billion. I don't know if that money's accounted for or pre-budgeted. I don't believe it is. But the push and the reminder to the American people of the benefits of Bidenomics, that splits with a number of people, including increasingly a number of Democrats who have their doubts. How does Wall Street react to this spending upon spending?
Well, I think it takes it in stride, basically, because you have to look at all the problems we've had over the course of the Biden administration. And so while it doesn't minimize it, it does say, hey, look, we're probably going to find some sort of resolution to this. It may not be the most favorable one, but something will get worked out. And then over time, too, as we approach the election cycle here that we've already started, certainly, and as we get there, say, next year, I think the market looks forward to maybe some more, say, more pleasant, let's say, economic scenarios in which stocks could perform better.
All right, Dave, I think we're back good with you here. Between that and the fact that Saudi Arabia and Russia apparently want to continue their oil production cut, I could see Russia doing it. Saudi Arabia, I thought was a friend, wouldn't do it, but be that as it may, it's all business. I get it. The impact of slightly higher oil prices today. Where do you see oil going as a wild card in all of this?
Well, I think given that markets tend to look very much forward and down the road, I think you're seeing the unpopularity of the green policies of the Biden administration is clearly part of what's weighing on him. And as that market looks down the road, I think it says, is it more likely that U.S. production steps up or declines? And I think at this point, it becomes quite clear that it's more likely that it steps up. And so, short-term oil prices will bounce around where they will, but I think we may have reached sort of peak green, and that can only sort of help on both the inflationary and the oil price fronts.
Gentlemen, I want to thank you both.